Welcome to Shark Cap Table Fast, the 1-minute deal maker that helps you keep your arms and legs. This tutorial is going to be about how you analyze a telemarketed investment that comes across my desk about 3 times a week. Now, the first thing you have to do is you have to be sure that you're set up the right way. Okay, investor is good, hide all help. We want to show the help, so we go here to show the help. We want to do a tele deal, so we're telephone deal. And then we still have red here that says use fast to evaluate a telemarketing deal for fairness by switching roles where you become the investor who buys units. But it says it's still in the combo mode, so go over here to Shark Cap Table Light and scroll up to where it says combo and click down here and make sure it's the equity deal. So that's the section D. Shark Cap Table Light, then come back to Fast, and we'll be ready to go. Now, you're going to see a lot of stuff in here right now because it's coming from the data acquisition area. So we're going to scroll down. We are going to split the screen, scroll up a little farther so we can actually see what's going on with a telemarketing deal. Okay, ringy dingy dingy, the phone rings and you've been offered private placement shares in Whizbang Corporation, a consumer products company. Do you hang up or listen? Well, try asking for the selling brochure and then use Shark Cap Table Fast to analyze the deal for fairness. Now, we have to assemble the data, so this is the area that we're assembling data. I've already put it in because of time constraints. The typical deal is a $10,000 unit price, 7,500 shares in a unit. That works out to be $1.33 share offering price, and they're 40 units. Now, we don't show any profit here because that comes when we actually enter the data. Now, the rest of this material here is a little bit difficult for you to get. Sometimes they won't tell you how much cash is invested, but they'll be sure to tell you what the additional value is, and I wouldn't believe it. You also can find out how many Whizbang shares are outstanding, and you also need the number of options, warrants, and convertibles. Don't forget these because they will try not to tell you about them because there is substantial dilution coming ahead in one of these telemarketing deals. So here's the total number of shares offered for sale. Total offering is 400,000. They think they're going to sell, of course, in year 2, and they're going to cash out for a modest $10 million. Well, we'll see. Now let's go back up here. We've actually given you the hints of what kind of numbers they need to be, so you can just equal whatever you see over here. Let's move these guys over so we don't get them in the way. Now, here's one we have to adjust because it says 3 million, so let's make it down to 3 million. And we know that there's a million option and warrants, so we have to crank that up. Now, it's not going to be exact. Don't worry, this is an approximation. And the next thing we need to do is we already see that $400,000 needs to be cranked in here. So we'll put 400K here. And we've already got the 10 million already in there. So you're just making the blue equal to the red. Now the last thing we have to do is we have to look down here. And we read here it says $1.33. Well, we have to make this $1.33 by cranking. You'll see it starting to move up. Now, it takes a while because the Whiz pre-money value, that stands for Whizbang, is highly inflated. And we have to make this equal the number that will generate the price per share that they're offering. It's kind of a reverse method. So we're almost there, 120, there we go. We're never going to get that exact, but it's okay. So now, let's unsplit the screen, and let's go look at what we've actually done. So, let's read across the top here. The overall ownership of the company is 23% warrants, 69% Whiz founders, and you, the unit holders, as a group only own 7%. The unit holders, if they sell in year 4, and oh, by the way, we have to make that year 4. Actually, we make it year 2 because that's what they wanted. Investment multiple is 1.7, so units as a group get 1.7 times their money back after waiting 2 years, and that equates to a 31.9% internal revenue. Internal revenue. Yeah, they'll be interested. Internal rate of return for the units as a whole. Now, the next thing I usually like to do is I say, heck, 2 years isn't going to do it. Let's make him occur in year 4. Well, that obviously lowers the internal rate of return. It doesn't affect the multiple, which is time insensitive. This is time sensitive. And let's try one more. Instead of the $10 million, let's see if they're lucky and get $5 million. Well, there you are. You have a negative internal rate of return. You haven't even returned your money. You've spent a whole bunch of money, and there it is. So it sure doesn't look like a very good deal. There's not enough in it for the investors. So let's go down here and ask ourselves a couple of major questions. Actually, there are 4. Are you really going to see this $10 million exit value, and what about the risks ahead? Haven't the founders and the option holders sucked too much out of the deal for hardly any cash? Well, of course, they're getting huge returns. And look at these returns. Look at these returns, and this is all you get. Isn't the pre-money value that drives share pricing way out of line with the founder's valuation? Well, sure. This is what you think the company is worth, and this is what they say it must be worth in order to get the $1.33 price per share. And the last one is, aren't you paying too much for too little? Well, that's correct. You're only getting about 7% of the deal. There's all those options and warrants out there. It's a one-sided situation. Now, I like to read this little disclaimer. We are on everybody's stupid investor list just so we can see the bad deals. Hardly a day goes by without a call from the telephone guy hyping a fabulous business opportunity. We usually get the documents, are not surprised that 9 times out of 10 they are terrible deals. The business proposition is supercalifragilisticexpialidocious and not properly priced for the risks going forward. The greed factor is incredible. Overpriced, over-promoted, burdened by upfront fees and commissions, and where sometimes only 50% of the money raised actually goes into expanding the business. Imagine that. There is no way the investors will make out on these deals. Nearly all returns accrue to the promoters. Our suggestion is swim, swim, swim away and keep your arms and legs. Now, having said all this, when crowdfunding becomes legal based upon the SEC, you people that would like to engage in crowdfunding on the purchase side, or even organize a company and raise money on the sell side, you can use Shark Cap Table to determine if you should buy one of those small $500 units or whether you can raise $500,000 by selling a bunch of $500 units. This Shark Cap Table Fast and Shark Cap Table Light are excellent organizing and structuring tools when you want to either buy or sell equity. Go out and buy the program. It's cheap. You're going to get another program with it called Shark Cap Table Pro, which does convertible debentures, preferentials, and a bunch of other stuff that's really needed in the business of selling to professional investors. And there's one more thing about Shark Cap Table Light. It produces the written materials for you for a executive summary and your all-important stand-up and deliver pitch in front of your investors, your VCs, or whomever you want to sell your investment to. Thank you very much.